$32 billion. That's how much Alameda Research was worth on paper until it was. The screen flashes red. A collapsing chart. A single line of text, FTX Trading Limited, and affiliates filed for Chapter 11 bankruptcy on November 11, 2022. Inside FTX's Bahamas headquarters, the air smelled like burnt circuitry and panic. Employees sprinted between terminals as withdrawal requests piled up $6 billion in just 72 hours. The exchange's coffers were empty. The number everyone trusted, the $32 billion valuation, was a lie. The panic wasn't just about money. It was about trust. Customers who had parked their life savings in FTX woke up to frozen accounts. One crypto trader in New York stared at his phone, watching $40,000 disappear in real time. His message to his wife: "We lost everything." Behind the chaos stood Alameda Research, a hedge fund that had grown into a financial juggernaut, closely tied to FTX. They moved billions in secret. They borrowed from customers to cover their own bets, and when the cracks showed, the whole system came down. Source: SEC Complaint, 2022-84, PDF. The complaint alleges that FTX and its affiliates, including Alameda Research, misrepresented the financial condition of the firm, which at its peak was valued at roughly $32 billion before the collapse. But how did a $32 billion empire crumble in just 4 days? A leaked balance sheet. A single line item, $8 billion loan to Alameda. No collateral, no explanation, just debt disguised as profit. Inside Alameda's offices, the mood shifted from arrogance to desperation. A senior trader later told investigators that executives knew the truth but kept the charade alive. "We were flying blind," he said. "The numbers didn't add up." The fallout wasn't just financial. It was personal. A single mother in Singapore who had invested her child's college fund in FTX lost $15,000. A college student in California watched his $20,000 crypto portfolio evaporate overnight. The ripple effects stretched from Wall Street to Main Street. The collapse didn't happen in a vacuum. It was the result of years of deception. FTX had marketed itself as a safe haven for crypto investors. Instead, it was a house of cards built on borrowed money and broken promises. Source: New York Attorney General Press Release, 2022-12-22. The AG alleges that FTX and its related entities misappropriated customer funds and used them to cover losses at Alameda Research, contributing to the rapid collapse. The question now: who was really in control? Alameda's CEO, Caroline Ellison, later admitted in court that she was following orders. But from whom? A courtroom sketch. Ellison, pale and trembling, testifying about hidden loans and fabricated loans. "We were hiding the truth," she said. "The balance sheet was a fiction." The collapse wasn't just about money. It was about power. About who got to decide where billions of dollars went and who got left behind. The numbers were faked. The loans were illegal, and the fallout would rewrite the rules of finance forever. Source: Reuters, 2022-11-11. FTX filed for Chapter 11 protection on Nov. 11, 2022, after a mass withdrawal surge and the revelation that customer assets were not segregated. Now the real question: how deep does the rot go? The screen fades to black. A single question lingers. What else don't we know? For viewers who may be new to this story, we'll break down the full timeline in the next section. But for now, this is how a $32 billion empire vanished in 4 days. This is SISTEMA Dark. The unraveling of the $32 billion empire began not with a single headline, but with a cascade of data points that, when lined up, formed an unmistakable pattern of deception. On day 1, a CoinDesk article questioned the integrity of FTX's balance sheet. noting that the exchange's publicly posted assets did not match on-chain holdings. Within hours, analysts traced a sharp drop in the exchange's native token, hinting that the reported $32 billion valuation was overstated. Source: Bloomberg article. Day 2 saw the first internal memorandum surface, an internal document later cited in the SEC complaint, that listed significant discrepancies between customer deposits and the firm's ledger entries. Source: SEC complaint. The memo flagged a potential shortfall, but was circulated only among senior finance officers. By day 3, a whistleblower identified only as a former senior accountant provided sworn testimony to regulators, describing how Alameda Research routinely transferred customer funds to cover its own trading losses. The testimony echoed the New York Attorney General's claim that customer funds were misappropriated to cover losses at Alameda Research. Source: NY Attorney General press release. Simultaneously, blockchain analytics firms published dashboards showing that a large portion of FTX's on-chain assets were locked in addresses controlled by Alameda. The analytics revealed that the exchange's reported liquidity pool was, in reality, a thin veneer masking a concentrated exposure to Alameda's proprietary trading strategies. Source: SEC complaint. Day 4 marked the tipping point. A mass withdrawal surge, triggered by rumors of insolvency, swept the platform. Within minutes, the exchange's order books froze, and the internal ledger displayed a gap that could not be reconciled with any known asset class. The Reuters report confirmed that customer assets were not segregated, a breach that directly violated the exchange's own custodial policies. Source: Reuters report. The next morning, FTX filed for Chapter 11 protection. The bankruptcy petition filed on November 11, 2022, noted that the liquidation crisis unfolded over 4 days, aligning precisely with the timeline of the internal disclosures and external analytics. Source: Bankruptcy petition. To understand how Alameda's trading strategies concealed the true exposure, we must examine the mechanics of its market-making operations. Alameda routinely engaged in paired trading, simultaneously buying a crypto asset on one venue while selling a correlated asset on another. On paper, these positions appeared balanced, but the underlying risk was concentrated in a handful of volatile tokens. Because the paired trades were executed through FTX's internal order flow, the exchange's public balance sheet reflected only the net positions, not the gross exposure. The internal documents cited by the SEC complaint detail how gross exposure figures were omitted from quarterly reports, effectively hiding the leverage that Alameda wielded. Blockchain forensics corroborated this omission. Analytics showed that Alameda's wallets held large, uncollateralized positions in low-liquidity tokens, positions that could not be unwound without slippage that would eat into the exchange's capital. When the withdrawal surge hit, these hidden positions turned into immediate losses, eroding the thin capital buffer that FTX had claimed to possess. The whistleblower's testimony added a human dimension to the data. She described a culture of creative accounting, where senior managers instructed finance teams to reconcile mismatches by moving assets between Alameda and FTX without proper documentation. This practice, she testified, was systematic, not an isolated error. The SEC's complaint stitches these strands together: internal memos flagging discrepancies, whistleblower accounts of asset commingling, and blockchain evidence of concealed exposure. Together, they form a proof point that the $32 billion valuation was not merely an overestimate. It was a constructed figure, supported by falsified ledgers and hidden trades. The chronology, 4 days from public skepticism to bankruptcy, mirrors the speed at which the underlying fraud unraveled. Each day added a layer of evidence, each layer tightening the noose around the enterprise. By the time the Chapter 11 petition was filed, the narrative had shifted from market volatility to systemic misrepresentation. The SEC, the NY Attorney General, and bankruptcy courts all cited the same core evidence: a balance sheet that never existed, a trading strategy that obscured risk, and a series of internal documents that proved the deception was intentional. In short, the downfall was not a sudden shock but a methodical collapse, driven by day revelations that turned a $32 billion empire into a cautionary tale of unchecked leverage and regulatory evasion. The screen cuts to a single line of text on a black background. November 11, 2022. On that Friday, the empire built on promises now valued at over $32 billion just months earlier collapsed into chaos. At 8:10 a.m. ET, FTX Trading Limited, and more than 100 affiliated entities filed for Chapter 11. The petition landed in Delaware bankruptcy court with one line that would echo across Wall Street: liquidity crisis. A real-time screenshot of the filing flashes on screen, time-stamped 8:10:12 ET. The document was barely 15 pages long, but behind those pages lay hidden liabilities the size of a small country's GDP. Alameda Research, FTX's sister trading firm, had been propped up by customer deposits. When a leaked Alameda balance sheet showed that $8 billion of assets were tied to FTX's own illiquid token, FTT, the cracks turned into cracks everywhere. A red banner appears. Margin calls begin. Within 72 hours, over $6 billion in withdrawals hit the exchange. Alameda couldn't cover the demands. Bloomberg reported that as withdrawals surged, FTX's liquidity evaporated, leaving customer funds frozen and exposed. A split screen. Left side shows a slow-motion withdrawal queue animation. Right side shows a real-time Twitter timeline scrolling at warp speed. The truth wasn't just leaking, it was going viral. On November 2, CoinDesk had published a bombshell. Alameda's balance sheet relied heavily on FTT, a token printed by FTX itself. The report didn't just question solvency, it questioned existence. Source: SEC complaint. The narration drops to a whisper. By November 8, Binance CEO Changpeng Zhao tweeted plans to liquidate FTT holdings worth $2.1 billion. A sell-off began. FTX's token plummeted 80% in hours. Source: Bloomberg. A digital ticker appears. FTT, 80% in bold red. The withdrawal surge became a bank run. Internal messages later revealed executives scrambling to hide the shortfall. Customer funds, supposedly segregated, were being moved between entities. Source: New York Attorney General press release. A close-up of a court docket entry from November 11. Petition filed under Chapter 11, emergency relief requested. The filing wasn't just a collapse, it was an implosion. Within days, over 1 million users were locked out of their accounts. Billions in assets vanished from sight. Reuters confirmed that customer assets were not segregated as required, meaning they weren't protected. They were exposed. Source: Reuters. The screen fades to a global news montage. CNBC, Bloomberg, BBC, all flashing FTX bankruptcy in rolling text. Media frenzy erupted. Regulators worldwide launched probes. Politicians called for hearings. The $32 billion empire, once a symbol of crypto's rise, was now a cautionary tale. But the damage wasn't just financial. Trust was gone. The tone shifts cold, final. FTX's bankruptcy wasn't an accident. It was the end of a house of cards built on borrowed time and borrowed money. Final on-screen text. The fall wasn't sudden. It was inevitable. The collapse of the $32 billion Alameda FTX empire is more than a headline. It is a stark reminder that oversight in crypto asset banking was, until now, a loose-leaf draft. The SEC complaint alleges that FTX and its affiliates, including Alameda Research, misrepresented their financial condition, inflating a valuation that evaporated in days. Source: SEC complaint. Within 4 days of a CoinDesk report raising balance sheet concerns, the exchange plummeted from that $32 billion peak to a Chapter 11 filing. Source: Bloomberg article. The bankruptcy petition filed on November 11, 2022, confirmed a liquidity crisis that unfolded in less than a week. Source: bankruptcy petition. What does this tell us about regulatory gaps? First, the lack of clear, enforceable standards for segregation of customer assets created a vacuum that allowed misappropriation to go unchecked. The New York Attorney General's press release points directly to the use of customer funds to cover Alameda's losses, a practice that would be unthinkable under traditional banking rules. Source: NYAG press release. Second, the speed of the collapse exposed a failure of real-time monitoring. Regulators received the first public alarm only after a mass withdrawal surge revealed that assets were not properly isolated. Source: Reuters report. These systemic flaws are not abstract. They are the very mechanisms that let a single empire tumble and threaten the broader market. To prevent another digital asset behemoth from falling tomorrow, we need stronger, technology-aware oversight that can keep pace with the speed of crypto markets. If you want deeper dives into how regulation can evolve to safeguard investors, hit subscribe and join the conversation. Remember, without proper checks, the next empire could crumble in a heartbeat, and the fallout would echo far beyond the crypto world.